about the federal interest rate hikes, the probability of rates hiking further, what the Fed is signaling, what the Bank of Canada is doing. The US sets the world stage, so we're going to chat a little bit about that. And then, of course, as you guys jump on here, whatever questions you guys have, throw them in the chat and we'll answer those as best I possibly can off the cuff. So yeah, anything personal finance, real estate, you guys know the drill. If you're new to the channel, welcome to the channel. I want to start making videos again. That's something it's on my 2023 bucket list. So I'm gonna start making videos again, maybe short videos where I illustrate, like examples of BRRRRs, how the BRRRR method works, maybe some deals, flip deals, how you do it operationally. But let's get back now. And I also want to take the first minute to also say one thing. I've opened up my calendar this year for potentially one every week or two, maybe twice a month. I will do a coaching call with someone special. So rosehartcapital@gmail.com, send me an email. Let me know why I should select you to chat with, but I will do a series of coaching calls. Right now I charge like $897 for a coaching call. I'm going to discount it to like $600 for a coaching call. If you buy 5 of them, it's like, $2,500 to $3,000. And then we can do them over a series of, one a month. So I'm going to throw that in there. It's something I'm going to start doing this year, try to do more of that and try to make it into a business. So I want to build, I want to take the revenue from the coaching and reinvest it into the channel so I can afford to pay editors, all of this kind of stuff to be able to produce more content without me having to do a lot of the heavy lifting. Like I used to do all my own thumbnails, my own editing, all of that. I don't want to have to do that as much. I want to be able to outsource it. So I'm going to try to make it a sustainable business. So you might see me plug a little bit more of that. But anyway, back to the interest rate discussion. So the Fed did last week effectively, they said that they're data driven, which basically means if they see that things are getting worse, that they may pause. But he said first and foremost, Jerome's number one priority was, Jerome Powell, was to get inflation down. And it's trending down. We're in deflation in certain sectors. But the challenge is that there's so much capital on the sidelines that the minute he didn't talk dirty, the stock market rallied. We saw a rally the last couple of weeks of about 16%, one of the strongest stock rallies we've seen in a long time. To me, that's signaling that it's easy for companies to raise capital right now still, and that shouldn't be the case. There shouldn't be record job reports. And when you dig into the data and the job reports, it's not as good as it looks, but it's still stronger than it should be, which is signaling potential for a resurgence in inflation. So they need to stay hard. And he said rate hikes, as in more than one. So we're getting another one at the next meeting in mid-March. We'll probably get, he said hikes with an S. So we're getting another rate hike, meaning it's going higher. And then it's going higher again, probably into the summer. And then there'll be a pausing period. It's possible that rates get cut towards the end of this year, but not likely. Seems like his exact words were, if our forecasts are correct, I don't see rates coming down in 2023. So a lot of people, who are bullish on real estate, bullish on stocks, whatever you're investing in, it's all tied to interest rates. We are completely in the hands of the Fed. If the Fed drops interest rates back down to 0%, markets will rally, stocks will rally, every business will rally, and real estate, of course, will rally. So everything will just do really well because it's easy to raise capital, and then there's growth. The longer the rates stay this high, though, there's some serious implications for the economy. One, if you look at the federal U.S. spending budget last year, and by the way, the proposed budget for this year, for some reason, Biden's administration hasn't factored in the change in interest cost. They still have the carrying cost at $300 billion when it should be $1.2 trillion. We're talking about a quadrupling of what it was. It is now going to be more than 50% of all government spending is just servicing the debt. That's a new reality we didn't have in 2022. It took a while for the rates to phase in. We're going to have that in 2023. So this will be the worst federal deficit that we'll see. And we're dealing with the fact that there's a fiscal ceiling. And, there's a bit of a deadlock in the House. So that'll be interesting to see how that plays out. I think from the stocks perspective, we're going to see a lot of volatility in the coming months. So would I say it's even if we have bottomed out, which I don't think we have, I think we're going to see another bottom. But even if I'm wrong, we'll get close to the bottom again in the next down trough. So that's just a reality. And then on the real estate side, it's hard to say, each market's different, but I think it's safe to say in Ontario, there isn't any huge appreciation wave coming. We're not going to rip up. Prices are not coming way up. We're going to see a little blip in the springtime pent-up demand. There is some cash sitting on the sidelines that's going to push things. And if that capital gets to work, it may create a small blip in economic activity that results in some boost in inflation, which is what we don't want to see. We want to see investors scared. We want to see investors saving. We want to see, like, the idea is that people aren't spending. And that's how you drive down inflation. That's how they tackle it from a demand side perspective. Now, also, as they raise interest rates, they'll also, in theory, crush supply side as well with that, because the factories can't afford to borrow capital to expand projects and whatnot, and to hire new people, and it's all tied to the cost of debt, right? Because we run our entire economy on debt, and most businesses are funded primarily on debt. So that's something to think through. That's why I want to title today's video about rate hikes and our forecast. Because when we're running our numbers on buying properties and buying businesses and our stock portfolios, we're having to make assumptions, and we need to be making the right assumptions. And I think it's important not to be. I love being an optimist, and I love thinking about the positive, and I'm a dreamer too, and I love to build out performance statements, and I love to focus on what can be and what what I'm driving towards from a dream and a vision perspective. But we have to rein some of that optimism in with realism, and say, hey, okay, if rates go higher, if our variable rates go from mid sixes to mid sevens, and then they stay there for a while, what does that do to the price of real estate? What does that do to the economy at large? And it's not good, right? It isn't good at all. For the government to sustain these levels, tax rates have to rise dramatically. Now, Biden has invested heavily in the IRS, and in Canada, they're investing heavily to increase tax rates, and that sucks for all of us because no one wants to pay more tax. 50% is enough for most of the entrepreneurs in Canada. We're tired of paying more than 50% in tax, and I'm sure they would love to take 60, 70%. And for the middle class, primarily, they would like to take more. That's their focus. So you can't take anything from the poor, so focus on those. And the ultra rich, they can lobby and find tax loopholes. So it's really only the middle class and the upper middle class that pay the whole tax bill. And corporations, to some extent as well, pay a large majority of it and have trouble getting out of a lot of that. Again, because the auditing scrutiny, it's hard to really, get around all that. But hey, Will, how you doing? Good evening. Good to see you on. Nico says, hey, Mike, what's your advice for first-time home builders in this mental market? So again, this is exactly a totally different market than it was a couple of years ago. I would say that, if you're taking on a new build project and it's not for your personal, for your own personal house, we have a different conversation, right? If it's a rental property, then you run your numbers and hopefully you're building something with multiple units or that is going to be cash flow positive. Very hard to do with new builds. I found that majority of my portfolio has been older buildings, deferred maintenance, at least 10, 20 years old. I'm never buying new because, again, when there's new, there's no value add opportunity. It's selling at premium dollar because it's a premium product. And so it's hard to cash flow that. I know it feels good in a portfolio. It's nice to have. It's a quality asset. But I usually go down a tier in quality, and I improve the quality myself through renovation and strategic repositioning. But primarily new builds and condos and all that pre-construction stuff and the actual building process itself is not a huge profit center. It can be if you manage it yourself, but if you're outsourcing everything, it's hard to really have a huge value add. I built a house in 2014 and it was finished built in 2015. And I think I finished the basement myself after we bought it. I got the builder just to rough everything in. And even with buying my own appliances, and I didn't go for any of the juicy upgrades. I avoided all the high cost stuff. I put a backsplash in myself for $500 instead of the $2,500 upcharge the builder was trying to shove down our throats. Instead of doing the poured concrete in the back, I just was like, leave it. I'll do it myself, because their price was like $6,000 to do it. I did it for $1,000. I found a guy with a concrete, company, and just I actually went to the builder's concrete guy who was building other houses and was like, hey, when you're pouring their driveway, come to my backyard. I'll hook you up with $1,000. That was how we did it. Those kinds of things can add some value in a new build process. You can get a little bit of an edge, but primarily you're just at the mercy of the market. And that's what I don't like about the new build stuff, is that you're literally just like buying into the market, which is fine, because I get the logic behind it is that over time, if you buy real estate, you'll win because it tends to outperform inflation, and you can lever it up. And you can also lever up stocks, but it's in a safer way, a non-callable debt, meaning if things go bad, you don't have to worry about it being, taken by the bank. As long as you make your interest payments, no issues. But if stocks fall in value, then they can potentially call that loan on you, right? So it's a different ball game. But that's the appeal there, I guess, of the new build stuff. I prefer cash flow positive stuff that's more than self-servicing, the new build stuff just doesn't perform, as well from a cash flow perspective in most markets. Now there are exceptions to that rule, but by and large, it really comes down to trying to find real estate that you could add value to. I get it if you're a busy doctor, or you're a busy banker. I have people who reach out to me who are in those categories, who work really busy jobs, or they don't have an interest in doing the active stuff. If you don't want to deal with all of that, okay, I can see where buying the new build makes a lot of sense. It comes turnkey. You got a 7-year warranty from Tarion in most cases. Most builders are registered with warranties. And if you use a legitimate, you do your research, get a good builder, then you're warranted for pretty much everything. So there's no maintenance and no capex in the first few years. It's easy. It's nice and shiny and beautiful and new, and you don't have to do a lot of work. So I get why investing in new builds can make sense. At the same time, in this rising interest rate environment, what are we seeing? Well, we're seeing builders go bust. We're seeing construction companies, the demand is dropping, so the price of labor will fall. Cost of lumber and other supply chain, related issues from the pandemic, they're solving themselves. And the price of lumber, copper, all that's coming down. Lumber's come down like 200%. It's like a 50% drop from where it was even a year and a half ago. So even more than that in some cases. So we're seeing material costs drop back down to reality. They're still, high, but they've come down a bit. So that's going to help, I think, translate eventually to lower build costs as some of these builders go belly up and people, there's tons of inventory comes on the market. You're going to be able to go to your builder and negotiate better deals. So on one hand, if you found a builder who is going bankrupt and you took over an almost finished project at 30% discount, that's a huge win. I love that kind of new build. That would make a lot of sense. There's a value play there. But if you're just going to buy at market value and speculate that by the time it's built or sometime in the future it'll be worth a lot more, I mean, that's a risky proposition. That's more like just buying the market, which is fine. Again, like I said, if you're a busy person who doesn't want to build a business around this, that's fine. It's a great way to get exposure because your chance of losing money, in a major way is limited. If you're brand new to real estate and you buy a big fixer upper, you have no idea what you're doing. It's like a $200,000 renovation. The contractors might take you for $300 or $400, or get you half done, and you get stuck with city permit issues, and you're screwed. I've seen investors go wrong buying big fixer upper projects when they don't know what they're doing. And so I would say, as a newbie, it's a good gateway to getting exposure, but you're not going to make a huge return. You're kind of subject to market returns, which I think over the next 5 years, or at least next 2 years, might be relatively flat. Over the next 5-10 years, I think there'll be very good prospects for real estate in general, just because, again, the immigration trends tend to support, the growth of the supply-demand imbalance that exists. There's just not enough supply to keep up with increasing demand. And so especially if you're buying middle-class and upper-middle-class homes, I think it's going to be a huge growth in that area. Right now, they're going to be suffering. There's going to be pain. But once we come out of this recession, that'll be the segment that'll do really well. And then the entry-level homes, too, do really well because everyone wants to be a homeowner. So there's that dream mind, that American dream, the Canadian dream of having that. And so I think, in a lot of ways, those are the sectors that I'd be wanting to be focused on. So if you could find new builds that are cheap, if you could find a $300,000 new build, that feels much better to me than in Canada. An entry-level new build's $600,000-700,000 at least for the most part. In London, Ontario, where I'm from, it's good luck finding a new build under $700,000. It's rare. So that's where, there's a disproportionate reality. I think the builders are building nicer stuff that people can afford. So just be careful being in that segment. The ultra luxury, I think you'll be probably okay in the long term, again, because the rich are getting a lot richer than they've ever been. And I think the entry level is going to do really well as rents, rise. Some people want to, just for emotional reasons, elevate out of the renting situation. So yeah. Hey Eric, how you doing? Eric says, job market is shrinking these days. I talk to different job agencies and cross-check with the real estate agents, and their sellers are not paying mortgages the past few months. Interesting, Eric. I've been hearing similar things. The default rates are on the rise. There's an interesting stat that personal credit, which is primarily credit card debt, is at an all-time high. I think we're getting close to $1 trillion in the US, and in Canada it's at all-time highs as well. And it's interesting that, if you look at the growth month over month in consumer debt and personal consumer debt primarily, which is like credit card debt and personal spending for the most part, right? Not business debt, not your mortgage, not investable debt, but personal consumption debt. It's rising at about 1.5% a month right now. And interest rates on credit cards are on average 1.5% a month. So what that's telling me is that no one's paying down any of their debt, And people have a limit, right? They'll get some limit increases, whatever, renegotiate stuff. But you hit a ceiling, and unlike the United States, we can't go to the bank and say, "Hey, I know my line of credit's 50 grand, and like I'm at the limit, but can we raise the debt ceiling? Like, let's just raise it up." The U.S. is doing that effectively this summer. That's going to happen. They're going to get together. They're like, "Hey, let's just raise our own credit limit." Like, that sounds like a cool idea. And everyone's like, "Yeah, let's do it," because the U.S. is a superpower, and no one can tell us we can't. And our currency is desired all over the world. So as long as that's the case, we can do whatever we want. But it's scary because as we move into this recession, there's going to be further pain. It's interesting though that stocks tend to rally as the economy hits the bottom. This takes like a year usually. There's like a trickle effect of like the layoffs don't really affect people for 6 to 9, 12 months. Typically, the stocks will rally because they're forward thinking. So the stock market's trying to price in 12 months from now, 18 months from now, and it's looking good 18 months from now. And so the market's rallying a little bit right now. So just keep that in mind when you're dollar cost averaging into your portfolio. I know it's hard to time the market perfectly, but just something to think about, that we're forward thinking. So when the pain is the worst, that's when you want to be buying the most. Same in real estate. Although the intersection of the bottom of real estate and stocks looks kind of like this, being the stocks will bottom here, real estate will bottom sometime after, because it takes a while for houses to sell, new comps to come up. Real estate's not liquid, so it takes a long time for it to happen. And the big like drops in price take a long time. And the effects of that take a while to manifest. So just keep that in mind. I'm continuing to buy real estate. I want to be, fully levered at the bottom. So you keep buying properties, you get into the swing of things. Ideally, you max yourself out close to the bottom and you use all the cash flow from the properties to service. But you want to get as much as you can under assets under management during that time. So as many properties as you possibly can that are cash flow positive. With a plan, of course, to be able to have emergency funds set aside, be able to carry if things get a little worse, because none of us can time the bottom perfectly. But again, buying the dip, super, super important, guys. I think this is going to be an opportunity of a generation in the next couple of years, potentially in the real estate space and in the business space. So I'm super excited for that. And I continue to buy in, and it's exciting what we're doing in the US here in Florida, and I'm just really, really excited about it. Eric says about the job market shrinking. I'm hearing similar things. Next part of that question was everyone you talked to said scary times ahead, even if they hold the rates. It's funny how the market is like so optimistic. The bond market is priced in a pivot by almost September, I think it was last I checked, like towards the fall. So they believe by the second half of this year, the rates are coming down. They think there's gonna be that much damage to the economy. The problem is the jobs reports keep coming out strong and data's lagged and it takes time. And so we have to be cognizant of the fact that that's something to think through as you're, building your real estate plan. This is a good time to start gearing up, I think, towards that bottom. Start taking deals on, start, swinging the bat, trying to get base hits, because if you can position yourself well through this next recession, there's an opportunity to 2, 3, 4, 5x your net worth. So for someone like myself, it's a chance for me to become $100 million net worth over the next, 5 to 10 years. So I'm really excited about that, be able to take my wealth to the next level. And this could be a really good opportunity to do that by potentially, this means probably I'll have to go back into joint venture partnershiping, doing joint venture partnerships with people, because that will allow me to scale faster. Also, it means potentially borrowing capital as cheaply as I can, but borrowing capital as long as I can sustain it and service it with debt. This is a good time to start doing that. But buying good properties that can service the debt is the key, though. You got to be buying cash flow positive stuff that can carry things. Nico says, thanks, Mike. Do you see value in construction project management in Ontario? I think that there is money for sure in the trades in general. There's good money. In project management, there is good money. There's a lot of people who are in project management who aren't good. So if you're good, you can make a lot of money for sure. It's a job like any other. I think that the challenge, I think, of being in the construction business right now is that the next 2 to 3 years aren't looking that bright. It's hard to sell. Like, construction businesses do their best in a booming market. So it's harder to make those sales and to grow top line revenue. So the good builders who have a lot of cash reserves, who aren't super debt ridden, because again, builders don't have good cash flow. Like, they have like no cash flow for like 10 months, then a sale. right? And if they have a lot of deals going on, maybe they've got staggered cash flows from all the sales. But the basic premise behind development, land development, and building is that you dump cash in for a long time and you service all of this with no inflows. And then you have a big event-based income inflow. And so that means that your cash management is super important. And your cash flow statement is probably negative most months. And so you need large reserves set aside. And some of the builders, they don't have large reserves. Or they got into big projects at the peak, where like in the peak of everything, when the Fed came out and said, hey, we aren't going to raise interest rates, go lever up. We want to come out of this pandemic strong. We're keeping rates near 0%. They went on the news and told us all that last year. At the start of not last year, sorry, 2021. I guess we're 2023 now. But in 2021, coming out of the pandemic, it was like, the ministers of finance in pretty much every developed nation, especially Canada, went on TV and were like, go borrow money, hire people, invest in your business and your infrastructure. They're like, grow, we want to come out of this pandemic strong. And so we're giving grants and subsidies and we're keeping rates low. And what that did, well, of course, when you print money without economic growth behind it, you create inflation. So they created inflation and now they've turned off the tap. And it's going to create, well, deflation, or deflation leads basically to economic collapse, right? If you keep the tap off long enough, it's a real problem, right? So they want to see, I mean, it's really possible that the Fed's able to get between the rock and the hard place and land softly. Unlikely, I think, but possible. There's going to be pain though, and bumps, I think, for other people. And I think that's important, when I suppose that's really, really important if you're going to be going in the building industry, is to just make sure that your downside risk is covered. And so if you're doing it as a project manager for a fee and you're able to lock up, you're able to find clients who are still wanting to build in this time, then yeah, project management is hugely profitable business to be in. I just think in general, the industry is suffering and the sector will continue to suffer. And so that'll be a bit of a headwind for you in trying to grow your business through that time. So, but if you enjoy it, I mean, do what you love and you'll still make money. Even through a recession, you'll be fine. You'll come out of the recession really strong. And the second part, Nico, was manage finances and subcontractor management for clients who don't want to do the work themselves. There's definitely money in that. Flippers and builders right now are getting crushed. A lot of them are, because they started projects at the start of the decline, and prices have fallen 30% in some cases. And that means that they're underwater. If you bought and you only had 20% profit margin, you have negative 10% now. And so how long can you carry losing projects? Which means you're literally doing all the work for nothing. That's a reality for flippers and builders right now. Some of them anyway, especially builders. Some of the flippers are pretty smart. At scale, it's hard to do it well, but if you're a smaller operation, able to get like a bunch of wholesale deals at really good dirt cheap prices, you can profit through this, which is what I've been doing. But if I had like 10,000 flips in the go, I'm sure I'd be bankrupt, right? Like there's just no way at scale to do it well. Your costs can't be kept under control at scale. And it's hard to find that many good quality deals. So anyone who's building at that huge scale, I think it's going to be a challenge in these coming times. So living the dub life, says dividend investing or rental property in Canada. I think that's kind of a loaded statement. I would say, or I guess you're making the statement, not really a question, but you think dividend investing beats rental properties. I'll give you an example of why that might not be true. So you could, in theory, set up in many places in Ontario now where it's illegal to do Airbnb. In most major cities, it's illegal to do Airbnb, or it's heavily regulated and there's licensing behind it. But if you could do an Airbnb property, the average $500,000 property can generate, let's say it's a duplex, in London as an example, could generate like $4,000 a month in rent. So that property would probably be cash flow positive, $500 to $900 a month. Just looking at a recent deal that I looked at. That type of deal in Ontario, you are not obligated to have any tenants in there. You can have it, fully staged and show ready at any time you want. You can cancel listings. You have credit card on file to book and to bill. That type of scenario, that type of rental property, you got a bank that's going to put a mortgage on it. You put 20% down. So you're putting $100,000 of your own money down, and it's non-callable debt. So if real estate falls further, it's already fallen 25, 30% in Ontario, but let's say it falls further 10%, it doesn't matter because they don't call the debt as long as you can make the payments and you're cash flow positive. Whereas you take that same $100,000 and in Interactive Brokers, you could maybe lever it up one time. So and that's applying a lot of leverage and that's a bit of risk, but I would say one time is pretty safe. So if you put 100 grand in, you can buy 200 grand in stocks because you can do it on margin. It's actually cheaper cost of debt to do it at interactive brokers and borrow against your stock portfolio than it is to borrow against real estate. So both you can apply leverage. It's hard to argue that one is better than the other, but this mortgage on your stocks, this callable margin loan, it it carries a level of risk, and you can't get as much leverage as you can in real estate. So the leverage piece is what makes real estate so attractive, because you can go 5 to 1. So your 100 grand buys you a $500,000 asset that if it appreciates 10%, your underlying asset is up, your down payment is up 50%. So 10% appreciation is a 50% lift. Now, if you buy a rental property that's undervalued, you buy a $400,000 property that's worth 500. That's not that hard to do. You can do it if you put in 100 hours and talk to all the wholesalers and the realtors, and you find something that needs a little bit of work, you renovate it, fix it up, boom, you've got yourself a huge lift. Whereas in the stock market, there's no, I can't go buy shares in Enbridge or Suncor or, TD Bank or Bank of Montreal. I can't go buy them at a discount. I can use options to buy them at like a 2% discount in the future. So I could say, hey, I'm going to buy BMO shares in 3 weeks at set price and make a small discount using options. So I guess you can get a little bit of a discount, but you can't arbitrage it. And this, like, stock options help you get a little bit of a discount, but not the same way you can in real estate. So real estate, if you know what you're doing, can take capital and grow it at like the base. If you even just bought like a property at market price, you didn't know how to buy a deal, you just bought like an at market property from a realtor, you know what you're doing, you didn't know how to find anything off market or add any value to it. Like, you bought a property for 500, it's worth 500. You're doing that cash flow option I was talking about. If you're buying something that's 500 grand that rents for 4 grand a month, it's a duplex, let's say. It's $500,000 duplex. Each unit's doing like $2,200 a month typically for like a three bed in London anyway. So you're like $4,400 a month in rent. Your net costs on carrying that, your mortgage is like $399,000 or something. You can do the math on it, all the expenses. You're looking at cash flow positive. And you're looking at more cash flow, like typically a 20 to 25% compounded ROI before you have your appreciation lift. So where can you get a 20% ROI in dividends? You just can't. Like, even the best dividend companies making 5 to 7% yield, the best dividend portfolios like my own is, with leverage, I get 10%, but like, that's applying a little bit of leverage to my dividend portfolio. 10% is like a really shitty rental property. That's like a crappy Vancouver, Toronto property in the core that like looks really nice on paper and you love driving by it, but has shit cash flow, like cash flow negative almost. You're right. So I guess if you're buying shitty properties and horrible locations with really low cap rates, that's comparable to dividend investing. But there are ways to buy real estate where you can get way higher rates of return compounded over the long term. So I like real estate as an asset class. One, because I don't worry about the price of it. I know in 20 years it's worth a lot more. And I believe in the underlying fundamentals of owning land and buildings that cash flow. So multiple units especially is really important. I think I like that a lot better than the single family stuff. If I can, I like a duplex or a triplex to reduce my vacancy exposure. So yes, I guess it's much more passive to hold dividends, but I feel like having both is important, where a dividend portfolio is really necessary, I think, for someone at my level, and for someone who's watching this might be at a similar level, is you can take that and go to private banking and you can get some really nice perks with that and a line of credit against that stock portfolio and use that to then buy real estate. Because let's say you're like me and you're an entrepreneur, the banks don't like you. They need to see 2 years of solid financial returns, which I finally have 2 years where I've claimed like really solid income. So now I'm an entrepreneur that is now in a different category. But when I first retired, for the first couple of years, I was building a business. So I was reinvesting and I was depreciating all my properties. So I was creating on paper losses. And so then the bank's like, I had a almost $2 million capital gain this year on my tax return. They'll use zero of that to qualify. Like, if I make $2 million in capital gains, they see me as unemployed, zero income. They would rather I have a job making 50 grand a year than make $2 million in a year in capital gains, because capital gains is an income. They can't use it to qualify. It's not sustainable. Even if it is sustainable, that's all I do. Anyway, but there's high net worth programs that most of the banks offer. I know for sure BMO does this, Scotia does this, CIBC does this, where if you show a certain amount of assets above the current debts you have, they'll use each dollar of excess net assets as qualifying income. So I can continue to buy properties. Like, it's how I have a $2 million mortgage on my house. And I shouldn't have qualified for that. You know how much income I would have to show to qualify for a $2 million mortgage on my house? Like, I think at these rates, it's like $700,000 in income. How many people make $700,000 a year, right? But then the way that all these people are buying and levering up is because they're using their stock portfolio or their liquid cash, because real estate doesn't count as liquid cash. It has to be stocks, bonds, cash. You could use anything that they can see and is tangibly liquid in a reasonable amount of time. You can use that to qualify for real estate. And so that allows you to keep growing your portfolio and makes it easier for you to borrow cheaply and grow that business. So that's why I got into a stock portfolio in the first place. That's the only reason I redistributed, or the primary reason, that's not the only reason, that I wanted diversification in my portfolio. I wanted to have, a balanced net worth that wasn't all heavily in real estate. And, I also felt that it's much easier. My dividend portfolio, I check on once a quarter. My rental properties, I'm getting fielding calls at least once a week or once a month, right, from the property managers. And there's always something going on, right, issues. So there's a time investment with real estate. And I can see why someone might feel like it's not worth it. But the ROI, if you make like less than $50 an hour and you compare that to your return with your time, I think rental properties outperform, 2 to 1, 3 to 1 in net return over a 5 or 10 year period. So I would choose the option that requires a little bit more time to manage, and I can sleep better at night knowing that my properties are producing cash flow and I'm not subject to market fluctuations that I am in a stock portfolio. But both asset classes are good, and I think you should have both. Next question was, William says, hey, Mike, good evening. How's the rehab going? It's going well, thank you. Good old Florida, beautiful Florida. We're down here all winter, and things are going well. We locked up a couple more deals, so I've been acquiring several more properties. We're very close right now on a few other big deals, which I can't talk about yet, but I'm excited to talk about. These are huge deals. So we may have 8 figures in assets in Florida soon in real estate. So that could be a reality in the next few months or a year. So that's a real possibility, and I'm excited for it. So I'll keep you guys posted with what happens there, and lots of good things. I may eventually end up moving, either to Florida or to the Bahamas or to a mixture of both of those for tax reasons and for just overall life enjoyment reasons in the next little bit. I'll probably still come back to Canada every summer because I just love Lake Huron. I love being at my cottage. And so I would always vacation in Canada, and I would always keep my Canadian citizenship. I'm a Canadian at heart, and I'll keep my passport, but I would just become a non-tax resident in Canada and move away. Yeah, I would still invest in Canada, potentially. There's still reasons why I think owning real estate in Canada can make sense. Long-term landlord-tenant board stuff, not interesting. Airbnb, short-term rental, furnished rentals, medium and short-term rental, I like that a lot more. Flipping in Canada, again, I also like that because Canada's long-term fundamentals are really strong for, especially if they can change the leadership. Leadership's horrible in Canada. Justin Trudeau's, then the Liberals have just taken this economy into the shitter, and they're not really focused on the future, I think, in the way that they should be. So hopefully there'll be a change in government. 67% of Canadians seem to be against Justin Trudeau, so that's a 2/3 majority now. I think if there was an election right now, he'd probably lose. So that's a good thing for Canada's long-term development. But again, there are no great parties in Canada because we're all pretty socialist. So it is what it is. Canada's a beautiful place. It's a beautiful country, really nice people. I love Canada. But just for personal reasons, I can't handle the snow and the taxes. Citizen M says, what's your email address if we want to reach out to you? rosehartcapital@gmail.com. That's how you find me. I do my coaching program that I'm going to be starting up through there. I might start a mastermind or something where, not a mastermind, but like a mentorship group. I had mentees before. You guys remember 4 or 5 years ago, I had 4 guys move into my house for a full time for a year, and we did deals together, and I took them from zero to hero. I've had like 6 mentees, and they've all done varying degrees of success, but fairly good success, and it was very rewarding. So I'm thinking I'm going to do something like that again, but differently. I'm not going to have people move into my house again. My wife's like, no, that's not an option. So it would be a virtual mentorship, but I think there's something really cool we could do, and I want to build a lifestyle around it. Like, I want to have masterminds in like Costa Rica and Bahamas and Florida, and like just be so fun to check out properties with like a group of peers, you know what I mean? And so I think there's also a big need in the market. There's a lot of, I don't want to say this the wrong way, but like there's a lot of bad actors, bad coaches, a lot of bad actors in the space that are taking advantage of people, charging a lot and not providing a lot of value. So I want to try to provide a lot of value, and I think it's a way that I could grow. There's a business there, and it would be both rewarding and fruitful. So it's something I should focus more on, and I plan to. But again, I don't need to, so I'm not extremely motivated. Again, money is It's great. I use it as a scoreboard, but I don't need it. I don't need any money. I'm good. So for me, it's like if someone's willing to give me money for my time, it makes me feel really good. I don't know why. It's like last year I made $100,000 a month net for most of, well, not last year. We'll call it 2021. I made around 100 grand a month with capital gains and everything all together. And it's like I spend like less than 6 grand. So I spend 6% of what I was making. And it wasn't all passive. Like I had a lot of active projects going too in real estate and whatnot. But it's like I still go to a store, and if I get like tonight we went to Blaze Pizza, and the manager gave us 2 free desserts. He loved my kids. He said, "You have 3 great kids. Awesome. Have a couple of desserts for free." And that was an amazing feeling. I don't know why, but like I'm still on a high from like $10 in desserts. I know it means nothing. It has no impact on my financial life at all. But little things like that have a big, they have a big lift on your mood, right? And when you help people, it feels so good. And when you don't charge people, they don't show up. They don't care. They don't put in the effort. So I found that when I charge people, they appreciate it so much more. It's stupid, but like it actually works. Psychologically, they're more likely to take action. Probably just reinvest it into this YouTube channel. It's one of the things I want to be doing in 2023. Big Up Penguin says, seems like you mostly live a frugal lifestyle. What are the areas you tend to splurge in? For instance, are you interested in sports cars? So I do live a pretty frugal lifestyle. I don't know. For me, I try to live a really kick-ass middle-class lifestyle on budget. So as an example, like I travel a lot. I'm down here in beautiful Florida. We'll probably take a trip to the Bahamas and Costa Rica this year, back to Canada. And in Canada, I'm at my cottage on the water. Like I live a great life. There isn't a lot more I can optimize for. You know what I mean? Like even if my net worth went 10x from where it is now, like what would I do differently? I guess to like think through your question, that's the better question to ask me. And like, I don't know if there was much I would change. I think I'd probably live. No, you know what? There is some things. If I had 10x the net worth, like if I was well into the 9 figures. If I was well into the 9 figures net worth, at that point, my passive income would be 8 figures a year. Yeah, I mean, I'd probably make some shifts. I'd probably make some changes. For one, if I fly, I'd fly only business class. And right now I fly, economy. So that'd be probably a change. I just can't stomach the cost difference. It just doesn't bring enough value to my life. But again, if money was no object at all, then yeah, I would probably do that differently. We already eat healthily, organic stuff. I'd probably eat out a little bit more than I do now, just because it's easier to eat out or to order in food than to make it at home. But then like you try that for a little while and you're like, you know what? I miss home cooked meals. And so I don't know. I live a good life. As far as like vices for me, it's I love travel. I love time with my family. Oh, you know what I would do for sure? And I'm still trying to do this now because I can afford to do it, is get a nanny. I need a nanny. I have 3 kids and like it's a busy, 3 young kids. If they were all older, it'd be a different story, but they're young and they're very needy. So that would be something that I would do that would improve my life. If I could find someone that was the perfect fit, like live-in nanny that became part of our family, like almost like an extension, like an auntie, like a second wife's strong word, like an auntie that was part of the family and lived with us and was on the same mission and core values. And like, that would be super sweet. That would be the biggest thing I could do right now to splurge on. But I think I drove a Tesla and it was beautiful. The self-driving feature, when I took my hands off the wheel and it turned around a corner, that was super cool. It's a beautiful car. I could see myself getting something like that. It's just not practical. So we have a van, but yeah, I guess to answer your question, no, like luxury real estate is something I like too. So probably I would ball out and get like a really nice mansion, and I would find a way to make it make economic sense. So we would do masterminds there, or I would have, a guest house with mentees in it or something. I don't know. But because for me, it's like, I just don't want to waste the money. I can't get past wasting it. But I would probably park a bunch of that capital into a really nice mansion. Yeah, I love luxury real estate. So that'd be something else I would do, is like, I'm a sucker for like a nice big mansion. It's on my vision board and I want that. My house at home I have a huge house at home. It's beautiful. And we have a 5-car garage, 7,000 square foot house, and it's great. Could be better. Could have a lot nicer house. So that'd be cool. But do I need it? Would it really make my life that much different? I don't know. Is it worth sacrificing blood, life, energy for that pursuit? to each person their own. I value freedom and the ability to choose what I do with my life more than anything else. So if you offered me a job making $10 million a year and I had to grind it 100 hours a week, I would say no to that job. That sounds crazy because that's like probably one of the most high paying jobs in the world, but I would say no to it. And that's because I have my freedom already, my FU money. Roy says, I'm able to save about $3,000 every month. That's awesome, Roy. Should I use the money to pay down my student loans at 7.45% interest variable, or should I buy stocks? Pay down your debt. 100%. If your debt is if your debt's more than 7%, pay it down. One, it's going to help you qualify for mortgages later and for debt to grow your businesses later, because student loan debt gets in the way of that. Two, I would say that the stock market right now, you have time. Well, I guess it depends. Depends how much student debt you have. Like if it's like going to take you a couple of years to pay it off and that's all you put your money into, I would say wait. And if you can buy the bottom of the market, like there's going to be a point, I think, towards this year sometime where we test the NASDAQ lows again. And if you can load into the stock market at that point, your potential downside is like maybe another 5 or 10% if you're trying to call a bottom. But let's say you just buy into like the NASDAQ bottom at 252 in October. 252, I think, was the low we saw. 250, let's call it. The 250 QQQ. So on the QQQ, we saw 250. If you buy in at that point, I think the most downside you have is maybe 10% more. But over a 5-year period, the upside you have is like 50 to 100%. So I don't know. For me, it's like, I'd be buying stocks actually towards the bottom, but not yet. Right now, the NASDAQ's like 304 at close today on the QQQ. I don't think that's a huge buying opportunity, and there'll be better buying opportunities. So if I had cash right now, I'd be paying down debt. Maybe do both. Do a little bit of both. Because the 7%, you said 7.5% guaranteed tax-free return is pretty decent. You got to make like a 12% return or like a 10% return and then pay tax on that income for it to be the same as a 7% after tax savings. So I think a tax-free 7-point-something% return is equivalent to a double-digit return. So you're getting a guaranteed double-digit return, and it's helping your financing in the future. Normally, I would say pay off the debt. If you have a high-interest car debt, any credit card debt, don't invest in stocks. Don't invest in stuff like that right now, because you could take it and get, if you have a credit card with 18% interest, it's not tax deductible, it's 18% after tax return. You need like a 25% return to get that same, more than that, like almost a 30% return to get a 30% pre-tax, to get the same net after tax return. So pay down credit card debt before anything else. That to me is like, blows my mind when I talk to some people and they're like, oh, they're showing me their financials. Like, oh, I have 50,000 in stock debt or in investments. I have 50,000 here in savings, and I have like 50,000 here on personal credit card debt. And I'm on the coaching call with them, and I'm like, this is such low hanging fruit, guys. Like, take that $50,000 you have sitting in a savings account and pay off that credit card debt. What are you doing? You're like, oh, I want to have an emergency fund. It's like, no. Your credit card is your emergency fund. Pay it off. Get an 18% tax-free return right now. What are you doing holding personal debt at those rates? I mean, that's a phenomenal return. So I would say take the risk. Like, not only, like, it might not be the best return you could possibly get, because in real estate you can get triple-digit returns, but there's risk. I mean, it's possible you make negative or zero in the stock market or in real estate. Unlikely, but possible. Whereas like 18% risk-free, I mean, that's the bee's knees. DWS says, do you write your own LOI or offers on deals you find? Do you ever use a realtor? I do use realtors all the time. They bring me pocket listings. I'm also not a realtor in Florida, so I have to work with someone there and get a referral back. Yeah, of course. I work with realtors all the time, and wholesalers too. And wholesalers do a lot of the paperwork on deals that are already locked up. They just assign them to me, right? So there's just assignment paperwork. A lot of the deals that I do are not from scratch. Have I written my own LOIs? Yeah, I've written lots of LOIs. Letter of intent. People who don't know that, in larger deals, when you're buying businesses or you're buying larger multifamily stuff, you always do a letter of intent, which is before the offer. It's a very common way of saying, here's the pricing I'm going to pay, the terms that I want, blah, blah, blah. And then you draft up an actual offer if they agree to your LOI or your letter of intent. And usually there's like a due diligence period or something where it works through the lawyer crafting the offer. But for bigger deals, for smaller deals, a realtor can write up an offer and it's done. In some countries like the Bahamas, they always do LOIs, and then they eventually move into the lawyer doing the offers, which is weird. Realtors should know how to write agreements of purchase and sale. To me, that's wild that they don't in some places. But primarily, I would say that I work with agents, and I pay to play. agents have the connections in the market, and often they can get you deals that you can't get on your own. So pay to play. But I don't primarily work with one agent. No, I work with lots of agents. And I'm an agent myself. Like, I'm a realtor myself, but I work with a network of wholesalers and agents because there's only so much on the MLS. Yeah, I can see everything there that's on the MLS, but there's a lot of deals that transact off the MLS, and that's important. You don't want to miss all that deal flow, all those realtor pocket listings that haven't gone live yet, the exclusive listings, stuff that might be just socialized in their network. So talk to people, as many people as you can. Will says, wanted to say I'm getting a lot of value off your Instagram Q&A stories, taking notes. Thank you, Will. Check out my stories on Instagram at Mike Rosehart. I did a live Q&A as my first ever where I was like, ask me anything, and a bunch of people asked me questions. I got like over 100 questions. I picked like my favorite 20 or 25. Probably a lot of them have expired now because they were all stories that I was doing yesterday morning, so a lot of them are expired now, but you can go and check. I saved them actually to a saved stories area called Q&A Knowledge Bombs, and you can click there and you can see them all. And I did a couple hours of dumping for free, so you can get some value from that and enjoy. So thanks, Will. Appreciate that. It was my first time doing it, and it was fun doing it, and I'm glad to be able to engage with you guys. It's what several followers have asked me to do. I'm trying to curate my content to what you guys want to see. So if there's something you want to see, you want me to talk more about, drop me a message and let me know, or shoot me a comment down below. And if you're watching this, hit the like button. I would appreciate that for the algorithm. And if you're watching the replay, hit the like button. You'll also notice that I'll probably be turning ads on, at least one ad per video again, because I want YouTube to start promoting my content. I was watching some more videos about how YouTube isn't promoting content that doesn't have any monetization because YouTube makes no money from it. So YouTube's got to make a piece for the message to get out there. So unfortunately, we turn them back on. It doesn't really matter to me financially. It's like a penny. I think I got less than a penny, half a penny when an ad plays. So it means nothing, but it means a lot to the algorithm. And so I respect that, and I want people to see this message, and I want it to get out there. And I haven't been focusing on this YouTube channel. I've been just doing my weekly live podcast show. By the way, I should probably title these, right? Like, I have 5 years of over an hour every week podcast episodes. That's 50, and I never miss one ever. I've never missed a Wednesday in 5 years. I've been sick. I had COVID. I went on. It was Christmas. I went on before. New Year's Eve. I went on. I will always go live every Wednesday, 7 to 8 p.m. Sometimes a little after 8 p.m., 8:30, the latest. And it's something that I'm proud of. That I've never missed a show. Not a lot of people can say they've committed to something, and when they say they're going to do something, they do it for more than half a decade. We're coming up on 6 years, I think, soon. My first ever one was with Graham Stephan. He's over at my house, and his channel's blown up now. But he was the first ever, I think it was the Money Madness Mondays or something, and I changed it to Wise Wealth Wednesday. It had a conflict with someone else, and I felt bad that I was streaming at the same time as their Monday show, so I changed it to Wednesday, and then I left it for Wednesday since 2017 or 2018 now, or 2023. So there's like almost 300 episodes, 250, at least 250 episodes of this show, me just shooting the shit. So there's so much content. I would love to number it and make it into like a playlist or something. And there's so much we could do with this channel beyond this live show, where I could do snippets and share like the knowledge bombs, cut it up and throw it up on YouTube Shorts and on Instagram and on Facebook. And just, I talk on this channel ad nauseum about how do you build a brand, and how do you, gather capital as a JV partner? Like, how do you find people who are interested in you? Well, you have to share and show what you're doing. People have to see the projects that you're taking down. They have to see your quality of renovations. They have to see the costs. Ideally, you post your tax returns even, like show them everything. And I'm transparent to do that. If I do a mentorship program, I'll show my tax returns. I'm not afraid. Only the bad mentors don't want to show their actual tax returns. I want to show the actual bank statements. I want to show what they're actually doing. And that's important, I think. You want to learn from people who are doers, who are successful at what they teach. If they're doing it as a means of income, that's when the coaching is making more than they're doing, that's a problem. Although I will say education space is the future. I think that brick and mortar universities and colleges are going the way of the dinosaur. And I think that people are going to start learning individual modules. And so I wished that at 17, when I was in my dorm room at Western University in my first year, that I had taken a different path than the Ivy path that I took, because I spent 80 grand on an Ivy finance degree. And what did it do for me? I mean, maybe some knowledge. I could have learned all the same knowledge and experience in like 2 focused years on Google researching. So I don't know. For me, it wasn't a good ROI, but for other people, it has been. And I think that people are going to start shifting more and more into the online space. So I believe that I'm a market leader. There are very few other real estate investors that know things that I don't know. There's a very select few people that in general know more about flipping and burring and have gone through what I've gone through. There's very few of us at the top. And I thought, at the top, there's very few of us that coach, right? A lot of the people I know don't coach or don't do a lot of coaching. There are a lot of coaches in the mid tier. People have done 5 or 10 deals and they're focusing on their building their program, or they've been doing it for like 2-3 years. They haven't been doing it for a long time. Not to throw shade, but like I've been a veteran. I've been in this more than a decade now, right? Like I started really young, and this has been my life. Like since I was 17 years old, 18 years old, I'm 30 now. This is all I've been doing, and I'm still learning every day. Right? There's lots of new things that I didn't know before, but it's I want to give back, and I want to position myself as an expert in this recession. I think there's a lot of opportunity too. If I built a mentorship program, that my mentees are going to be bringing me deals. And I have a huge network, so I can help them assign and wholesale those deals. We can share in the profits 50-50. They might find flips and be like, hey, Mike, I need, and I have great lenders, by the way, that'll lend like, I have lenders that'll lend me like 8% on flips, 8-9% on flips all day long, first mortgages. So I can pass those opportunities and those perks, or I could fund them myself and say, hey, I'll fund the deal. They find a deal like, hey, I found a $700,000 flip that's worth 1.5 million. And when I teach my students how I look for deals and the secret sauce, they're going to be finding opportunity and they're going to bring it to their mentor. And then we're going to partner up. Like this is just to me is a way that we're going to 10x and take advantage of this bottom coming in the next couple of years in real estate. So I'm excited about it. The entrepreneur in me, the business hustler in me is like, this is an opportunity I can't pass up. So you're going to see me dive into this space in a more significant way. All right, I got to do some quick Q&A here. I'm way past my time. My kids are going to go to bed soon. Dominic says, question, how can you do real estate when you have a full-time job and job on Saturday? Dominic, it's called moonlighting. Moonlighting is the idea that you basically do the job while you're doing another job at the same time. So that's what I did a lot of the time while I was working in consulting for 3 years. I worked in business management, IT consulting. And I would be on my lunch break dealing with tenant calls and or I'd be lining up. I used to line up a couple showings on my lunch break, and I would drive over to the property. It was like 5 minutes from my work, and I would do a bunch of showings. And then as I was getting home from work, I'd look at the applications and approve them. So, I mean, I was doing renovations while working at 9 to 5. I worked like 8:30 to 5:30 typically. But anyway, I get off work and I go meet the contractors and we'd work in the evening. And I was able to get projects done. So yes, you can still do it. You're gonna have to push yourself. So don't do maybe a lot of projects, maybe do one rental property. One property, a couple hours a day, and you'll move the needle forward and you make a great return. So you can definitely still do it. You're gonna have to put yourself out of your comfort zone probably to do it. Or if you don't want to and you're like, hey, I don't want to hustle, I don't want to grind, I don't want to put the extra time in to get ahead, you could just hire a property manager. Buy property, use your jobs. You have 2 jobs, it sounds like. Buy the property, buy a good quality deal, underwrite and look at a lot of deals. And through underwriting all of those deals, you'll learn what is a good deal. And once you've underwritten a good deal, put it under contract, buy it, and just outsource everything. Outsource property management, tenant placement, maintenance, all of that. And you're just basically like sitting back and coordinating with your property manager who's doing most of the work for you. And it can still be a very cash flow positive venture if you hire smart. And even if you don't, it still can be profitable depending on which markets you're investing in. So, yeah. Daryl says, planning on coming down to Florida to buy. There you go, Daryl. We'll see you down here. You know what I love about Florida is there's just so much more opportunity. Like, there's like 1 hotel for sale in Ontario, like 2 hotels for sale. And like in my area, I'm looking and there's nothing. Here, there's like 100 hotels on the beach, all for sale. There's like 300 multifamily properties, all for sale. The entirety of Canada, pretty much population-wise, fits inside of Florida. Like it's like the whole country in one spot, which is amazing. There's just so much opportunity. So that's what gets me excited about coming down here. And it's so capitalist in nature, which means there's more opportunity for capitalists to thrive. So I love that. Chinook says, hello, Mike. Glad to hear about your deals in Florida. What do you think about student rentals? I grew up in student rentals. That was how I started. My first properties were student rentals. My second, third, fourth, fifth, like all my that was the primary way that I invested in real estate because I understood students. I was a student myself. At 21, 22, I could understand what they wanted. I knew the target client and what they were looking for. And so that's how I built my initial business was like, I knew I could rent out rooms and I could take a house that was 3 bedrooms and I could convert a dining room, put a door on it. Now it was an extra bedroom. In the basement, there was 2 offices. I could pop in windows done. Or I could make the windows bigger. Boom, now I have like a 5-bedroom house. I knew I could rent those out for $550 a room. Now I knew I was cash flow positive from day one. I could take a single family that rent for $1,400 a month back in the day, and I could get $2,500 a month in rent. So student rentals were my bread and butter, cash flow business. You never had long-term tenants. You never had the landlord tenant board. None of that, right? Like my tenants moved every couple of years. So I was always set to market rents, which is great. Long-term, I think student rentals are a fantastic business to be in if you can manage it well. Because again, the student tenant turnover is expensive and time consuming. So there are cons for student rentals too, pros and cons, but it's a great business. I love student rentals. It was the way that I, got into the business initially, into real estate. Big Up says, what would be your requirement to get into a virtual mentorship program? Big Up, I don't know. Primarily I'd want someone who's going to be putting in the time, right? That's going to really put in the time to grow. I want someone who's going to take what I'm teaching and take action on it. So action taker is probably the most important thing that I'm looking for, but also just vibe. Like, do I want to talk to this person? Do I want them part of the program? Do I like them? Those are qualitative things, but like I can judge whether someone's going to be successful typically by just having a conversation with them. And I'm not always right, but I would like to select people who I think are going to succeed. I know some people are going to fail. It's just the nature of things. Someone's going to give up on stuff. You can't be 100% perfect, picking only great people. But that's what I want to do, is have largely success with my mentorship program. So that means I have to be a bit selective. William says, I want to know how to get from 3 million to 5 million. Time. I mean, legitimately, it's just like 3 million to 5 million is like 6 years. And that's if you do nothing but buy the market. And we're in a recession right now. So if you buy the dip now, 3 to 5 million is like potentially 2 years, because we're in one of the biggest recession dips. So in the next 2 years, there'll be an opportunity to dollar cost average in 3 million and turn into 5 million doing nothing. Now in real estate, you could turn 3 to 5 fast. If you just took $3 million and bought 25% down on every deal, it's called 25 because that's less leverage, easier. That's 4 to 1. So 3 million buys you $12 million in property. If you buy $12 million in property in Ontario over the next 10 years, I guarantee you that property is going to be worth 20 million. And so in 5 to 10 years, 20 million means you have 8 million in upside. Plus you pay down your mortgages over that time. So you just turn 3 million in down payment into 11 million in a 5 to 10 year period. Like, that's just compounding working for you, and leverage and debt working for you. If you can buy stuff that'll self-service, you can carry all that debt. Hopefully that made sense and I didn't go too quickly with that, but time is how you do it. It's inevitable. Don't put it all in one thing and YOLO. Just safe, careful, diversified bets. Brock says, hey Mike, 200K, 4-bed, 1.5 bath cosmetic flip available. Good timing. Could rent rooms out. Sounds great. I mean, 200 grand for, I don't know your market. So if all the houses there are 150 grand and you're paying 200 grand, that might not be a good deal. To me, it sounds like a good deal because again, in my markets, every house is way more expensive than that. So that seems like a lot of value to me. I mean, it seems pretty decent. I don't know the fundamentals of that area, but you can rent out bedrooms and make good cash flow. 200 grand, you could probably rent the house out for like $1,800 a month. I don't know where you live, but like in general, probably enough that it'd be cash flow positive, even as a single family, as like worst case scenario. So Will says, I was going to mention this to you, Mike. If you hired out a couple editors to take your content and create some flashy knowledge bomb YouTube shorts, your channel would blow up. More private money. Well, you're totally right. And you're not the first person to tell me this. Like, I have a lot of friends who are like, Mike, your shit's lit. Like, you drop knowledge bombs that no one's dropping and no one watches your content. Like, not, I mean, we get 1,000 or 2,000 or a couple thousand views, and like, my stories get a couple thousand views a day, but like I can have 100,000 views or 1 million views, right? And so that's something I'm investing heavily in so many areas and so many businesses and in real estate, and then I'm not investing anything in the YouTube channel. And it's a business that's generating nothing. Like, I could totally take this knowledge that I'm giving for free and continue to give for free, but then have a funnel where there's, it could lead to investing together. And that's a win-win for everyone, right? Like, there are a lot of people probably watching this channel who have $1 million sitting aside, and they're like, it's sitting in a savings account making 4%. Like, I could be the hero to take that capital and make it make 15% for someone, right? Or 25% in a deal, right? By JBing with me or by lending it to me and funding deals. That's a win for me and a win for them. So all you need to do is just create win-wins for everyone. And that can be an amazing thing. It doesn't have to be predatory. business can be very much a win-win, and I love when businesses are, and the mentorship business piece also fits into that too, because I want to expand my reach and have reach in more markets and have more deal flow. And if I can train an army of people to think how I think and analyze and underwrite deals how I do it and lock them under a contract, I could partner with them to either take those deals down and flip them, long-term hold, or wholesale. And so there's just so much more opportunity. I need to explore that space. It's something I should do. I should do. People keep telling me I should do it. I should do it. They're right. I haven't been investing time into it, but I should. Zaleen says, thanks, Mike, for sharing your valuable knowledge. No problem. Raz says, will you raise your kids knowing they're rich? I mean, I think my kids already know that they're blessed to an extent, but I make sure that they have deprivation in their lives. And that's intentional. I want them to, I say no a lot. And I want them to know that they are not, that they cannot have whatever they want, that my money isn't their money. At the same time, though, I had friends growing up who treated their money and their family, and still to this day do, as a family pot, and they all work together to grow it. And I think that's the way you build generational wealth, is you teach them that it's their job to then take this baton and keep running with it, right? Like I want them to be in the family business and help grow this to get us into the billion range and multi-billions. I'm gonna need their help, right? At a certain point, I'll get old and I won't be able to carry the baton. Hopefully not. Hopefully there's scientific advancement that I don't age anymore. But I mean, realistically, it's possible that my kids are gonna have to take this over and grow it. And hopefully if I hand them, a huge business, that they can take it to the next level that I couldn't. So the hope is that I can teach them to take things to the next level. But I hope that they have a hunger, and that is a hard thing to teach. But I think just, trying to show them that through delayed gratification, they have the opportunity to have so much more in life, that they'll hopefully have a similar mindset to myself. But we try our best as parents. That's all we can do. Bruce says, I'd like to buy a property in Florida and renovate it myself. As a Canadian, I'm able to work myself without a visa of some sort. So Bruce, you can't work in the US without a visa, I don't think. Well, if you bought your own property and you fix it up yourself, how would, how would they know that you fixed it? It's a vacation property. How would they know? I don't know. Legally speaking, I think you probably do need a visa. It's not hard to get a visa. You go buy a business down here, buy a laundromat for 200 grand, and you get an E2 visa. You can be here as much as you want. And that's a visa permitting you to run your business here. So it's not that hard to get one and still be a Canadian citizen and have an E2 visa. If you invest a certain amount of capital, an E5 visa does a similar thing. Mike said, and by the way, that's because the US government wants you to be investing in jobs. And so if you have a business here that you own, even if it's like a laundromat or a car wash or something super automated that you barely have to run, relatively passive in nature. Even real estate can qualify if you buy like a hotel or a small motel, like an 8-unit motel for like 900 grand or something. Lots of stuff you could buy. You could finance most of it and put a couple $100 grand down, and boom, you got a visa in the US. Mike says, what is an average ROI for a BRRRR deal in London or Florida? Well, in practice, or I guess in theory, a BRRRR deal, theory and practice are slightly different. But in theory, a BRRRR deal means you return all of your capital to yourself. Like a perfect BRRRR would be, not only do you get your down payment back, but you also get your renovation capital back and your carrying costs. So a perfect BRRRR, and they're rare. We never get a perfect BRRRR, like maybe one a year, you know what I mean? Like they're not all perfect BRRRRs. But the idea is you trap as little money as possible. And so if you had a perfect BRRRR that lasted 6 months and you put in 100 grand and 50 grand for renovations and you got it all back within 6 months, you have no money in the deal. You've refinanced at a level that you've pulled all the capital out. What's your ROI calculation? Infinite. You put in the calculator, it comes up 0 because you have no money in the deal. You've pulled out all your money. It's just created Fugazi equity. It's this value created equity that's left in the deal. You refinanced out tax-free all of your own money. This happens a lot. I've had a lot of deals that were perfect BRRRRs where probably more than I deserve. I've got a lot of unicorns and I'm blessed for that. In a lot of ways it's positioning myself, working hard to get those opportunities, but in some ways it's been luck too, right? But when you have no money in the deal, your ROI is infinite because you've pulled everything out, especially when you use leverage. And that's sexy. That can be really, really quite interesting. Bow, bow, bow. Maria says, hey Mike, currently a student at an acclaimed business school in Canada. I've done a fair share of research into real estate investing. Would you recommend for me to complete my degree or to begin real estate investing? Maria, when you say you're at an acclaimed business school in Canada, I hope you don't mean Queen's Commerce, um, or Rotman, U of T, or I guess DeGroots is kind of okay too. They're probably in the top 10, I think. Um, I'm just messing with you. I'm an Ivy grad from Western, so the Richard Ivy School of Business is the best if I had to choose. It's even better than Harvard. It's not, but modeled after. Awesome. That's good to hear. It's a great program. You know what's nice about coming out of a program like that, Maria, is that I know that pretty much everyone coming out of that program who can show me that they're in the top half of the bell curve in their class by means of grade is and has the potential to be successful. Means you're really smart and you're really hardworking. You don't need to have that Ivy degree to be successful, but I know that you are successful if you're in that criterion. I graduated top 20% of my class, and that meant that the program didn't make me special. I was already a hard worker. I was already smart. It didn't make me any better, but it definitely shows someone who doesn't know you when they first meet you, hey, this guy's super hardworking and smart, or this girl is super hardworking and smart. So I think you'll succeed and you'll thrive, especially because in general in real estate, in the smaller space, like duplex, triplex, sixplex, even some multifamily stuff, there's unsophisticated investors, mom and pops who don't know what they're doing. And I meet so many people like this who have $5 or $10 million or more. And I've met some guys who have 50 million bucks. And it's like over a lifetime, they just bought some properties. They didn't apply any good strategy. They didn't burr. They just overpaid in some cases and bought property that didn't cash flow, made no sense. And they're super rich today because of appreciation, right? Just luck, but not luck. They were working and holding the property and maintaining it over all this time. And yeah, that's, you should. I think it's a great business to be in. It's a great field to be in. With that business degree, you could work in the industry in some way and build experience in that industry. I think real estate's a great place to be in. Probably complete your degree. If you're already in the degree program, that's a difficult decision. I would say just get through the degree and moonlight. Like if you're interested in real estate, get a real estate license. Or if you're interested in working for a real estate firm, go and shadow under someone who's in the field, or work in the real estate industry in some way to build experience and exposure. And that's the way you can really get ahead. And yeah. Raz said, oh, there's a super chat. William says, probably hit a bank cap around 1 million based on salary. Who would you use to borrow from in Florida after your first few deals? There are so many lenders in the US and in Florida that will lend to, they like the property, 25, 30% down, no questions asked, no tax returns, no bank statements, no nothing. They don't care about income at all. Just show us a property that rents for more than the mortgage payments and carrying costs of the property, and we'll fund it. There's a lot of lenders in the US doing that, even for like foreign investors like Canadians. But yeah, I mean, better financing terms should come probably from going through your bank first and doing like a vacation property here or something. But yeah, you don't cap out. You never cap out. Just go to commercial financing. You can go forever. Thank you for the super chat. Raz says there's a thaw from -30 to +4 Celsius, a roof leak above garage. Can I fix myself or do you need to hire a roofing company? I mean, probably get a handyman to have a look at the roof, or a roofer, and say, hey, explain what's going on. See if you can shoot them a couple $100. Maybe they can go up there and do some tar. Maybe some shingles have lifted. I don't know what kind of roof you have. I don't have any details, but if the shingles are in relatively newer shape, like they're 5 or 10 years old or less, repair for sure. If the shingles are all curling and your roof's 25 years old in Canada, I mean, you gotta replace your roof. So it depends. It really does depend. And William, for loans, yes, that's correct. All right, everyone. Thanks so much for watching. I went late tonight. We're almost 8:30 at night. So thank you so much for watching, everyone. And we'll see you next week, every Wednesday, 7 to 8 p.m. live Eastern Standard Time. You know where to find me. And on Instagram, Mike Rosehart. And on Facebook at Mike Rosehart. Anyway, thank you, everyone, for watching. And we'll see you next week. The secret to unlocking wealth through you is still just 3 levers and control your financial future. Spend less, earn more, and maximize returns in the difference. All right, everyone. Have a good Wednesday night. See you next week.